Welcome, welcome, welcome. Welcome to the Deep Dive. I'm so glad you're joining us today for an exploration into a topic that I know resonates with so many of you, especially as we look at the financial landscape for our younger generations. We're talking about the pivotal journey to that first $100,000 in investments. And, it's not just a number on a statement, right?
Not at all.
It's a profound psychological milestone, a true turning point that can really redefine your entire relationship with money and, well, your future.
Absolutely. And this deep dive, it's really all about unpacking that fascinating, often hidden interplay between our minds and our money, especially tailored for you, whether you're maybe Gen Z and just starting your investment journey, or perhaps you're just curious about mastering the mental game of building wealth.
Right.
We've gathered some truly insightful sources today, ranging from cutting-edge behavioral finance research to detailed studies on Gen Z's unique investment habits, and even some, timeless lessons drawn from actual millionaires who built their fortunes basically from scratch. Our mission today really is to give you a shortcut to understanding the mental game of early investing. We want to provide a roadmap to not just accumulate wealth, but to do it with confidence, clarity, and a much-needed dose of self-awareness.
Okay, let's unpack this then. This deep dive is all about understanding the why behind our many decisions.
Yeah.
Why we save, why we spend, why we take risks, or maybe why we sometimes just freeze up. And then charting a course that leverages psychology rather than, being sabotaged by it. Because let's be honest, our brains, for all their brilliance, can sometimes be our own worst enemies when it comes to making smart investment choices.
That's so true.
We're going to dive into the data, explore the human elements, and hopefully leave you with some tangible strategies to navigate your path to that crucial first $100,000.
Thanks, great.
Let's start by maybe setting the scene for Gen Z. What does their financial world actually look like right now? Because the data suggests a generation that's paradoxically both incredibly savvy and, well, at the same time, profoundly financially anxious. It's this fascinating kind of complex contradiction.
It really is.
Yeah.
What's truly fascinating here is precisely that contrast you just highlighted. On one hand, we see a massive, undeniable, and frankly kind of unprecedented interest in investing among younger generations.
Right.
For instance, data from KSCI, that's the Central Securities Depository in Indonesia, it shows that nearly 60%, 59.91% to be exact, of new investors entering the capital market are under 30 years old.
Wow, nearly 60%.
Yeah, it's huge. And this isn't just like passive curiosity, mind you. This generation is actively putting part of their retained funds into investments. They are engaged, they're curious, and they are participating in the capital market in really significant numbers, which, marks a substantial shift from how previous generations perhaps approached investing at the same age. They're digital natives, they grew up with information readily available, and that seems to translate into an inherent financial savviness, or at least interest.
So they're engaged, they're interested in the capital market, they're actively putting money in. That sounds incredibly promising, like they're off to a fantastic start.
It does sound promising.
But then, as you mentioned, we also hear about these significant challenges they face, which almost seems to pull in the opposite direction. What's the other side of that paradox?
Indeed. Despite this impressive engagement in investing, there's a striking counter-narrative that paints a picture of real vulnerability. One report highlights that a significant 55% of Gen Z individuals are living paycheck to paycheck.
55%. That's more than half.
More than half. Imagine that.
So,
Essentially one unexpected expense away from real financial trouble. This creates an immediate and intense tension between their aspiration to invest and their daily reality. And critically, financial worry isn't just some minor concern. A comprehensive study by EY identifies it as a top driver of anxiety for this demographic.
a top driver. Wow.
Yes. So this raises an important question for us. How do these pervasive anxieties, coupled with the very real conditions of living paycheck to paycheck, impact their actual investment decisions? It suggests that even with the best intentions, the mental hurdle to investing consistently and confidently can be substantial.
That's a huge point. It sounds like their emotional and financial lives are constantly intertwined, maybe more so than we realize. So what specifically drives their intention to invest, especially in areas like socially responsible investing or ESG, which Gen Z is often strongly associated with? It can't just be about raw financial returns, right, given these other deep-seated concerns.
You're right. It's far more nuanced than just chasing returns. Research actually gives us some pretty clear insights into Gen Z's motivations, particularly for ESG, that's environmental, social, and governance funds. Their intentions seem to be significantly influenced by several key behavioral factors.
Okay, let's break those down.
Okay. First, there's perceived behavioral control, PBC. This is basically how much they believe they can successfully execute their investment decisions.
All right, like, can I actually do this?
Exactly. For a young investor, navigating this sea of investment apps and online platforms can be both empowering and, frankly, overwhelming. High PBC might come from the ease of opening a trading account on their phone in minutes.
Yeah, he's easy.
But low PBC can stem from a lack of formal financial education, leading to analysis paralysis despite their interest. Too many choices, not enough confidence.
Makes sense.
Then we have subjective norms, SN. This refers to the social pressure they feel from important people around them, friends, family, even online influencers to invest.
Oh, FOMO effect.
Absolutely. Fear of missing out. This is massively amplified by social media. If their peers or these finfluencers they follow are constantly talking about investing in X or Y, the pressure to conform to not miss out becomes a powerful, often unconscious driver.
I can see that.
Their overall attitude, ATT, towards such investments also plays a critical role, naturally whether they view them favorably or unfavorably. And beyond these, they're strongly influenced by perceived consumer effectiveness, PCE.
Okay, what's that?
PCE is their belief that their investments can genuinely contribute to a better future, whether it's fighting climate change or promoting social equity. For Gen Z, who often seem deeply concerned with global issues, PCE can be a huge motivator. They really want their money to do good.
So values-driven investing.
Precisely. And finally, there's perceived financial performance, PFP, which is, of course, their expectation of how these investments will perform financially. They still want a return.
Of course.
However, and this is a key psychological barrier we mentioned, perceived risk, PRI, has a significant negative impact on their intention to invest.
The risk factor.
Yes. If they see an investment as too risky, maybe they've seen friends lose money on volatile crypto assets, or they're just too close to living paycheck to stomach a significant loss, they're significantly less likely to participate. Even if other factors like the ESG impact are positive, they're constantly weighing the potential good they can do and the potential returns against the very real loss they might incur.
So this first $100 K, it isn't just about the money itself, is it? It's intrinsically tied to overcoming these inherent anxieties and navigating these complex psychological barriers.
Exactly.
What does reaching that particular milestone, $100,000, actually mean psychologically for someone starting out? Why is that number such a talked about, almost mythical target?
You've hit on a crucial point. It's a powerful psychological threshold, far more than just another number in your portfolio. Think of it almost like achieving financial escape velocity.
Escape velocity, I like that.
Yeah. The journey to wealth, especially to that first significant sum like $100,000, is often cited in research and anecdotes as being more satisfying even than the destination itself. It represents a tangible, undeniable step towards genuine financial independence. Suddenly, the abstract concept of wealth becomes concrete and, more importantly, achievable for you.
Right, it's not just something other people have.
Precisely. For many, $100,000 isn't just capital, it's leverage. It offers a real sense of control over one's time, allowing for more choices, more freedom to perhaps pursue passions, and crucially for Gen Z with their identified anxieties, significantly reducing those omnipresent financial worries.
That sense of control must be huge.
It is. It means moving from a position of always needing money for immediate survival to one where your money is actually working for you. It's about setting and achieving economic goals, which brings immense personal happiness and validation. That first $100,000 makes the abstract dream of wealth a very real personal accomplishment. It fundamentally shifts the mindset from scarcity to possibility.
Okay, so it's a massive mental shift.
Huge.
All right, here's where it gets really interesting, I think. We're talking about the psychological traps, or as I like to call it, the minefield, that can derail even the most enthusiastic and well-intentioned young investor.
The minefield. Good term.
These aren't just minor missteps. They're often deeply ingrained biases that can severely impact your returns over the long run. Let's dive right in with one of the biggest culprits. Overconfidence.
Overconfidence is absolutely a big one, and it's pervasive across all investor demographics, but perhaps especially insidious for younger investors who, feel they might have an edge due to digital access and endless information.
Right.
It's the tendency to overestimate our abilities, our knowledge, and our future prospects more than reality actually warrants. In investing, this often translates directly into excessive trading.
Trading too much.
Yes. Studies by researchers like Barber and Odeen have consistently shown that this kind of chasing the market or frequent active management strategy often leads to higher risks and, counterintuitively, lower net returns over time after accounting for fees and taxes. We think we know more than we do, and that conviction drives action that, ironically, often isn't in our best interest.
So more trading doesn't necessarily mean more profit. It feels like it should, doesn't it?
Yeah.
Like the more you're in the game, the more opportunities you have to win. Our intuition often tells us that effort equals reward.
Not typically for the overconfident, no. The research is actually quite clear on this. There's effectively no correlation between investors' self-assessed skill in identifying stocks and their actual historical performance.
Really? No correlation.
Basically none. Meaning people who think they're great at picking stocks are often no better than, say, throwing darts at a list. Yet, despite this lack of actual skill, the belief in a better-than-average skill positively correlates with increased trading volume.
So the more confident you are, the more you trade, even if you're not actually any good.
That's what the data suggests. Overconfident investors are also more prone to taking on higher-risk stocks and under-diversifying their portfolios, essentially putting more eggs in fewer, riskier baskets. This can be particularly dangerous when a single stock or sector takes a dive. And interestingly, studies also show that single men, in particular, tend to have the highest risk portfolios. This suggests there might be a potential gender and marital status component to this bias, perhaps linked to a higher tolerance for competitive risk-taking or maybe a lack of spousal checks and balances.
Interesting observation. And what about the impact of readily available information on this overconfidence? We're living in an age where information and, let's face it, misinformation is literally at our fingertips 24/7. Does more information help or hurt here?
It's a classic double-edged sword, and for overconfidence, it often hurts more than it helps. While genuinely valuable, filtered, well-understood information can, of course, improve accuracy, simply having more information often boosts confidence at a much faster rate than actual accuracy, especially for less experienced investors who might be relying on unfiltered or unsourced information.
Right, you feel smarter because you've read more stuff.
Exactly. Getting more data makes you feel more knowledgeable, even if your ability to interpret it correctly or distinguish good information from bad hasn't improved proportionally. This is why online message boards, social media influencers, or even just the sheer volume of daily financial news, despite often containing little genuinely valuable information for making informed long-term decisions, can lead investors to feel significantly more knowledgeable and overconfident.
Yeah.
This perception then frequently results in increased trading volume without necessarily leading to better outcomes. It's like having 100 maps, but none of them are actually reliable, or maybe you don't know how to read them properly.
That makes perfect sense, the illusion of knowledge.
Okay.
Okay, so what's another common bias that can trip up young investors, perhaps even more subtly than overconfidence?
Okay, next up is the disposition effect. This is a classic and incredibly potent behavioral bias that really gets to the core of how we deal with profit and loss emotionally.
The emotional side.
Yes. It describes our deeply human tendency to sell winning stocks too early to lock in that feeling of pride, that I made a good call feeling, and conversely, to hold on to losing stocks for too long to avoid the painful feeling of regret that comes with admitting a mistake.
So we're essentially chasing good feelings and actively avoiding bad ones with our money, rather than making purely rational long-term decisions based on a company's fundamentals or prospects.
Yeah.
It sounds like we're letting our emotions completely dictate strategy.
That's exactly it. When you sell a stock at a profit, it validates your initial decision, and that feels good. It's a surge of pride, a mental pat on the back. Selling at a loss, however, means confronting a mistake, admitting you were wrong, which triggers a very negative emotion, regret, self-blame, maybe even embarrassment.
Yeah, nobody likes feeling wrong.
Nobody. This psychological mechanism is incredibly powerful. People even subconsciously increase their mental reference points for winners more than for losers. They keep resetting the bar for what counts as a win to keep that good feeling going. And the irony is, if a winning stock's price falls after you sell it, you feel doubly happy both for the initial profit and for the perceived good timing of your sale.
Right. Phew. Got out just in time.
Exactly. And that psychological boost actually makes you more likely to repurchase that same stock later, even if it's not a fundamentally sound decision anymore, simply because of that positive emotional association. It makes learning from actual investment mistakes much, much harder.
Okay, wow. That's a powerful one. Then there's the pressure of the crowd, right? Herding behavior. This feels particularly strong today with the amplification effect of social media and online investment communities. It's not just about what we think, it's about what everyone else seems to be doing.
Yes, herding is a huge factor, and it's a powerful force shaping investment decisions, maybe more now than ever. People aren't just making these choices in a vacuum. They learn about investing through conversations with neighbors, friends, and increasingly, as you said, through online communities.
Yeah.
They pick up cues and adopt similar strategies, sometimes without even realizing it. Research shows that social households where people talk about finances are more likely to invest in the stock market. We even see this phenomenon in quite formal settings. There was a fascinating study of university librarians.
Librarians? Okay.
Yeah, librarians. It found wildly different participation rates in retirement plans across different library buildings on the same campus, even though they all worked for the same institution and had the same plan options.
No way.
Yes. It highlights the strong peer effect. If your colleagues down the hall are doing it, you're more likely to do it too, sometimes regardless of your own personal research or suitability.
Just following the herd. And the media plays a huge role in this herding too, right?
Mm.
Especially with all the hype that can surround certain trends or hot stocks, pulling everyone in one direction.
Definitely. Vivid language and hype from the media can powerfully influence investors, particularly those who might otherwise hold, more contrarian or independent positions. Investors often react quickly, sometimes impulsively, to news, even if the information is actually stale, trivial, or purely cosmetic.
Like a company name change or something.
Exactly. Think back to the infamous dot-com bubble of the late 90s. Firms simply adding .com to their names saw significant stock price increases, even if they had no core internet business or hadn't changed their operations at all.
Right, just the name.
Just the name. It was purely driven by investor optimism and widespread herding, a collective rush into anything that sounded like it was part of the next big thing. There was that crazy example of Palm and 3Com after Palm's IPO.
Oh, yeah, I remember something about that.
Right. The embedded Palm stock within 3Com was valued by the market at more than the entire 3Com company itself. It made no logical sense, but it demonstrated how easily collective optimism and herding can lead investors to ignore or minimize bad news or clear mispricings.
Oh, wow.
This kind of short-term, emotionally charged focus can be incredibly costly to long-term wealth accumulation. And for Gen Z, this is amplified, I think, by viral trends on platforms like TikTok or Reddit forums, where a stock can become a meme overnight, almost independent of its underlying value.
That's a really important point for today's environment. So, okay, besides hype, how do we interpret past performance or even choose what to invest in the first place? I imagine there are ingrained biases there too. Our brains are always trying to make sense of the world, and sometimes they take shortcuts, right?
Absolutely. That brings us neatly to familiarity and representativeness, two close cousins in the family of cognitive shortcuts or heuristics. Our brains are hardwired to use these heuristic simplifications to process information quickly, but they can really lead us astray in finance.
Okay, what's familiarity bias?
Familiarity bias causes us to invest disproportionately in what's comfortable and known, like companies from our own country often called home bias.
Right, investing mostly in U.S. stocks if you're in the U.S.
Exactly. Globally, despite the U.S. market being, say, about 43% of total world stock value, U.S. investors typically hold a much, much higher percentage in domestic stocks than would be optimal for true global diversification. Or another big one is investing heavily in your employer's stock.
Oh yeah, that feels safe, right? You work there, you know the company.
It feels safe, but it's often surprisingly risky because your income and your investments are tied to the same company's fate. We stick with what we know, even if it's not the best strategy for spreading risk effectively.
And chasing winners sounds like it relates to the other bias, representativeness, believing that what went up will just keep going up.
It is directly related. Representativeness bias leads investors to extrapolate past returns, assuming that good or even bad performance will simply continue indefinitely into the future. They chase winners, buying stocks that have trended upward, believing that the recent past is perfectly representative of what's coming next.
But that's not usually how it works, is it?
Often not. Historical data actually suggests the opposite tends to happen over longer periods.
Hmm.
Losing stocks, those that have underperformed significantly, often tend to outperform previous winners over the subsequent 3 years or so, sometimes by a significant margin, maybe around 30%, according to some studies.
Wow, 30% difference.
Yeah. And what's even more problematic is when employees combine these two biases, they often invest more in their company's stock after its price has already increased significantly. They're driven by both familiarity, it's their company, and representativeness. It's been performing well lately.
Double whammy.
Exactly. Despite no real evidence that these firms perform better for them in the long run just because the stock went up recently, this leads to dangerous under-diversification, putting their job security and their retirement savings essentially in the same potentially volatile basket.
Yikes. Okay, finally, we absolutely have to talk about emotions.
Yeah.
They must play a huge, perhaps even the biggest role in all of this, right? Our feelings can just sweep us away sometimes.
Absolutely. Emotion and mood are powerful, often unconscious drivers of investment decisions. They can sway us profoundly, sometimes without us even realizing the connection. Well, external factors, for example, can impact our risk tolerance in subtle ways. Good weather, believe it or not, has been shown in some studies to promote risk-taking, making people feel generally more optimistic and less risk-averse on sunny days.
Sunshine makes you buy stocks.
Maybe slightly more likely, or at least more optimistic about them. Studies have even tried to link stock market returns to seemingly unrelated things like lunar cycles.
Lunar cycles.
Seriously. Yeah, it sounds wild, but people have studied it. Also, the outcomes of major sports events where local companies associated with losing teams might temporarily underperform.
Oh, like the city's mood affects the local market.
Kind of, yeah. And even things like the endings of popular TV series have been looked at. These seemingly trivial events demonstrate how collective mood can aggregate and potentially bubble up into tangible market-level effects. Our individual feelings are powerful enough, but when lots of people feel the same way at the same time, the market can really move based on sentiment, not just fundamentals.
That's wild. So even a good mood or widespread optimism can actually be dangerous in investing. We usually think of optimism as a positive trait.
Yes, it can be, if it's ungrounded or excessive. While a certain degree of optimism is healthy and arguably necessary for progress and long-term investing, buying a stock whose price is primarily driven by collective, uncritical optimism usually leads to losses when the optimism inevitably unwinds.
And it always unwinds eventually.
Reality usually catches up, yes. Furthermore, people often try to resolve cognitive dissonance, that really uncomfortable feeling you get when you hold contradictory beliefs, like, I'm a smart investor and this stock I bought is tanking.
Right, that mental clash.
Exactly. To resolve that discomfort, our brains do mental gymnastics. We might start blaming others, oh, it was the fund manager's fault, or the market is just irrational. Or we might selectively remember past returns, focusing only on the brief period when it went up, conveniently forgetting the crash.
Yeah, rewriting history a bit.
Precisely. We do this to protect our ego rather than confronting the reality that maybe we made a mistake. Imagine you poured savings into a stock everyone on a forum was hyping, but now it's plummeting. The feeling, I made a bad decision, clashes with your self-image. So you might tell yourself, I knew it would be volatile, I'm just holding for the long run, even if that wasn't your original plan at all. This makes it incredibly difficult to learn from our mistakes because we're basically shielding ourselves from the feedback. Some research even shows people overestimate their past investment returns by a significant margin, with less experienced investors overestimating by over 13% in one study. It shows how deeply ingrained this self-deception can be.
13%. Wow. Okay, so we've mapped out the minefield. Now that we understand these psychological traps, the biases that are pretty much hardwired into us, let's pivot to the roadmap. What habits truly build wealth, especially for that crucial first $100 K, and how can we leverage that understanding? Here, maybe we can turn to the millionaire next door philosophy. It offers some incredibly counterintuitive but powerful insights from actual self-made millionaires.
Yes, that's a great place to look. And it raises a really important question. What truly sets apart those who manage to accumulate significant wealth from those who don't, especially when they often start from similar circumstances or income levels?
Right.
A core lesson, maybe the most profound one from that research, is living below your means. The vast majority of actual millionaires don't clump their wealth. They live far, far below their perceived status. As a famous saying from the book goes, wealth is what you don't see.
Wealth is what you don't see.
Exactly. Hyperconsumption, chasing status symbols, trying to keep up with the Joneses, That's actually the fastest way to have less money, not more. It's a direct drain on your ability to save, invest, and let compounding work its magic.
So the image of wealth we often see pushed on us in media, on TV, maybe even in our neighborhoods. You know, the flashy cars, the designer clothes, the huge houses, that isn't accurate for most truly wealthy people.
Yeah.
It's almost like a marketing illusion.
Precisely. The advertising industry, Hollywood, social media influencers, they've conditioned us to believe that wealth and hyperconsumption go hand in hand. But the reality documented in studies like The Millionaire Next Door is quite different.
How so?
Most millionaires don't live in sprawling, expensive homes in exclusive neighborhoods. They're often found in modest residences in ordinary middle-class areas. The phrase big hat, no cattle perfectly describes those who look wealthy, driving the expensive car, wearing the luxury watch, but actually have very little net worth.
Big hat, no cattle. Love that.
Yeah. True wealth is often hidden, carefully managed, diligently saved and invested, and not displayed. This makes it hard to learn from by simple imitation because the real examples are often invisible. Think about that incredible story of Ronald Read.
Ooh, the janitor millionaire.
Exactly. He was lionized in the media after his death at 92. He worked as a gas station attendant and a janitor in Vermont. He drove a beat-up old Toyota Camry, wore thrift store clothes, clipped coupons religiously. No one, absolutely no one, would have guessed he had quietly accumulated an $8 million fortune over his lifetime.
$8 million.
$8 million, which he then left mostly to a local library and hospital. He was nobody's financial role model while he was living. Every penny of his wealth was hidden. He perfectly embodied living far below his means.
That's an amazing story. Can you give us another concrete example of this living below your means mentality? What does it look like in maybe a more typical everyday life for someone building wealth?
Certainly. Consider the engineer couple mentioned in the Millionaire Next Door research. Both had good jobs right out of college, but they made a conscious choice to live on just one income and diligently saved the other entire income.
Lived on one, saved one.
Yeah. And anytime they got raises, they simply saved more of that additional income, resisting lifestyle inflation. They lived in the same modest 1,900 square foot home for 20 years, resisting the constant societal pressure to upgrade to something bigger and fancier.
Takes discipline.
It does. Or think about the millionaire wife who, even after receiving $8 million in company stock as part of a major payout, continued to cut coupons, buy clothes on sale, and meticulously track every penny her household spent.
Even with $8 million.
Even then. For people like them, the rewards were deeply intangible. The feeling of financial independence, the satisfaction of discipline and self-control, and the quiet pride of being a good provider or setting a good example. These were more valuable to them than the fleeting pleasure of product-related consumption. They prioritized long-term financial security and freedom over short-term outward displays of affluence.
This philosophy naturally leads to the next crucial step for accumulating wealth, doesn't it? Budgeting and planning. It seems it's not enough to just intend to save. You have to know exactly where your money is going and have a plan for it.
Yes, this is an absolutely key factor underlying wealth accumulation. It's one of the biggest differentiators between the truly wealthy and those who simply earn a lot but don't build lasting wealth. What the research called prodigious accumulators of wealth. Pause, okay. Pause either meticulously operate on a well-thought-out annual budget, tracking income and expenses, or they rigorously pay themselves first. This means systematically investing a minimum of, say, 15% of their annual realized income before paying for any consumption. It's a non-negotiable first step each month or paycheck.
15% before anything else.
Minimum, yes. In stark contrast, under-accumulators of wealth, UAWs, tend to spend first and then maybe save what's left over at the end of the month, which, more often than not, means they save very little or sometimes nothing beyond whatever might be automatically deducted for a pension or 401k.
So spend first versus save first.
It's a fundamental difference in mindset and approach. One is proactive and intentional, prioritizing the future. The other is reactive and often leaves nothing for the future.
It sounds like a significant commitment of time and attention is involved here too, not just good intentions. This isn't a passive activity, is it?
Absolutely not. Pause, the prodigious accumulators, allocate nearly twice the number of hours per month to planning their financial investments compared to UAWs.
Twice the time.
Yes. And this isn't just about staring at spreadsheets. It includes things like consulting with financial advisors, actively searching for and vetting quality accountants, attending financial planning seminars, reading books and articles. It's an ongoing, active engagement with their money and their future.
Hmm.
Furthermore, a hugely significant factor in a household's eventual wealth position is your spouse's orientation toward thrift and investing.
Ah, the partner factor.
Yes. Households where both partners are on the same page, living below their means and actively contributing to budgeting and financial planning, they accumulate significantly more wealth. It truly is a team effort, and financial harmony or lack thereof within a relationship is a powerful predictor of financial success.
That makes sense.
And fundamentally, without accurate, detailed records of expenditures, it's incredibly difficult to control spending electively, which directly impacts your ability to accumulate wealth. A good accountant, or even just a robust budgeting app these days, can be invaluable in helping to set up and maintain such a system. You need to know where the money goes.
And for young investors, perhaps the most powerful tool they have is time itself. The concept of starting early and compounding is paramount, yet it's often profoundly underestimated because its power isn't immediately visible, is it? It's like planting a tiny seed and having to wait years to see the tree.
This is a cornerstone, perhaps the cornerstone of long-term wealth building. And it's where time truly becomes your greatest asset, more valuable than picking the perfect stock. Warren Buffett's astounding financial success, for example, is largely attributed not just to his undoubted investing acumen, but crucially to the financial base he started building in his youth and the remarkable longevity he maintained throughout his life.
So skill plus time.
Exactly. His skill is investing, but his ultimate secret weapon, as many financial historians and analysts point out, is time. Decades and decades of compounding.
Can you explain compounding simply, like the snowball analogy?
Yeah, the snowball analogy is perfect. Think of compounding like starting with a small snowball. That's your initial investment. As you roll it downhill, it picks up more snow. Those are your returns, your interest or dividends or capital gains.
Right.
Then, crucially, that new layer of snow starts picking up even more snow on the next roll. Your returns start earning their own returns, and so on. The longer the snowball rolls downhill, the longer your money stays invested, the faster and bigger it grows.
Not in a straight line, though.
No, that's the key. It grows in a powerful, accelerating curve, an exponential curve. Compounding doesn't rely on earning huge, flashy returns every year. Merely good, reasonable returns sustained uninterrupted for the longest possible period of time will almost always win out over higher, perhaps more volatile returns achieved for shorter periods.
Right. Consistency over intensity.
Exactly. People often underestimate this because the results seem counterintuitive to our linear way of thinking. The truly explosive growth of compounding takes time to reveal its immense power, especially in those later years. That first $100,000 might feel like a slow, hard grind, but it's the critical foundation upon which your wealth truly begins to accelerate later on.
That snowball analogy really brings it to life.
Okay, now what about parental support? Getting help from family. Is that always a good thing when you're trying to build your own wealth? It seems like it would be a huge advantage to have a financial safety net or get a head start.
That's a great question, and it raises an important and often quite counterintuitive point. How does external support truly influence financial independence? Research, particularly from the Millionaire Next Door authors, indicates that avoiding economic outpatient care, EOC, is actually crucial for building self-made wealth.
Economic outpatient care, what's that? EOC refers to significant cash gifts, large inheritances given early, or ongoing financial subsidies from affluent parents to their adult children. While seemingly helpful and given with the best intentions.
Yeah, seems generous.
It is generous, but it can inadvertently dampen the recipient's initiative, their creativity, their drive, and their overall productivity. It can become habit-forming, fostering a sense of entitlement, perhaps, or just leading to continued dependence rather than encouraging genuine self-reliance and the development of wealth-building habits.
Really? So getting money can make you accumulate less.
The data shows a statistically proven, robust relationship. The more dollars adult children receive from their parents in the form of these gifts and subsidies, the fewer dollars they tend to accumulate on their own through their own efforts. While conversely, those given fewer dollars tend to accumulate more through their own work and savings.
So parental subsidies can actually hinder, rather than help, wealth accumulation in the long run. That really goes against conventional wisdom, doesn't it?
In many cases, yes, it seems it can. Gift receivers often start to perceive their parents' wealth, subconsciously perhaps, as part of their own income to be spent, rather than as capital that maybe their parents earned and should be preserved or invested. This can lead them to spend more and invest less of their own earnings. They might feel financially well off, maybe statistically similar in lifestyle to truly affluent non-gift receivers, despite having less actual income and substantially less accumulated wealth themselves. It can create a dangerous false sense of security.
Right.
We see countless examples cited where parents try to create debt-free environments for their kids by funding businesses entirely or providing huge down payments for homes without requiring the child to contribute significantly from their own resources. Often, these ventures fail or the house becomes a burden because the child, the entrepreneur or homeowner, lacks the essential skin-in-the-game motivation that comes from personal risk, personal sacrifice, and personal investment.
They haven't earned it, so they maybe don't value it as much.
That seems to be the psychological dynamic. It prevents them from developing the resilience, the discipline, the problem-solving skills, and the true self-reliance that are fundamental to building and maintaining wealth over a lifetime.
So the ultimate goal, psychologically and financially, should true financial independence earned through one's own efforts.
Exactly. Mr. Allen, one of the financially independent individuals interviewed extensively in the sources, articulated it perfectly. He said, and I'm paraphrasing slightly, if your goal is to become financially secure, you'll likely attain it. But if your motive is just to make money so you can spend money on the good life, you're never going to make it.
Powerful quote.
It really highlights the critical importance of intrinsic motivation, the desire for security, independence, achievement for building wealth, over the purely extrinsic motivation of consumption and just wanting to look wealthy. It's about self-control, setting the right long-term priorities, and finding satisfaction in the journey of building something for yourself.
It sounds like building wealth isn't a free ride, though. Even if you do everything right, it comes with its own unique set of challenges and costs that aren't just about making money or finding the right investment strategy.
Not at all. There's always a price of returns. Market returns are never truly free. They demand a price. But its currency isn't dollars and cents, not directly anyway.
What's the price, then?
The price is paid in volatility, in fear, in doubt, uncertainty, and regret. These are the emotional and psychological costs. They're easy to overlook or dismiss when the market is steadily climbing and everything feels great.
Yeah, everyone's a genius in a bull market.
Exactly. But these costs hit you hard, right in the gut, when you're dealing with them in real time during a market downturn or a period of intense uncertainty. It's essentially the cost of admission you have to pay to get returns potentially greater than those offered by low-fee, low-volatility parks like cash, CDs, or maybe very safe bonds.
The cost of admission.
Yes. You can't realistically expect significant long-term returns without accepting these inherent, often uncomfortable psychological costs along the way. Ignoring them, or thinking you're immune to them, often leads to panicking and selling at the worst possible time, destroying years of compounding.
And how do we prepare for that inevitable price? What's the best defense against those emotional and psychological tolls that come with market volatility?
By consciously building room for error, often called a margin of safety in investing terms. This is one of the most underappreciated forces in finance, yet it's absolutely critical for long-term success and, frankly, for staying sane.
Room for error. What does that mean practically?
It means not betting every single chip you have on one outcome. It means not optimizing your plan solely for the best-case scenario. Crucially, it means assuming that your plan might not go exactly according to plan. Because life happens, right?
Right.
Curveballs. Exactly. Life throws curveballs. Markets inevitably have downturns. Your job situation might change unexpectedly. Having a frugal budget, maintaining flexible thinking, maybe holding some cash reserves, and investing in companies or assets you genuinely understand and believe in for the long haul, these can all provide this vital buffer.
Also, financial shock absorbers.
That's a great way to put it. This margin of safety allows you to endure those inevitable downturns and unexpected life events without being forced into making desperate, ill-timed sales just to cover expenses or simply to assuage panic. Forced selling at market bottoms is one of the biggest wealth destroyers. Having room for error maximizes how well you sleep at night, which is often far more valuable and sustainable in the long run than chasing some theoretically optimal but psychologically fragile strategy that leaves absolutely no room for error or unexpected setbacks.
Sleep well at night investing. I like that. Okay, so for our listener who's aiming for that first $100K, What are the really concrete steps and mindset shifts they can make right now to leverage all this psychological insight and truly win the mental game of investing? How do we put all this into practice?
All right, let's get practical. First and foremost, it's about know thyself, counteracting biases. The very first, most fundamental step to gaining self-control and making better financial decisions is simply understanding these psychological biases we've spent time discussing today.
Just being aware.
Just being aware is huge. Once you're consciously aware of things like overconfidence, the disposition effect, herding behavior, familiarity bias, and the others, you can actively start to recognize them in your own thinking and work to mitigate their influence. Self-awareness is truly your superpower here. Just knowing when your brain might be trying to trick you is genuinely half the battle.
Okay, but how do we actually do that in practice beyond just being aware? It's one thing to know you might be overconfident, but it's another thing entirely to stop yourself from acting on it when you see a seemingly hot stock tip online or all your friends are piling into something.
That's the hard part, right? It involves developing specific investment criteria, clear, written down rules for how and why you invest, and then, critically, sticking to them rigidly, almost mechanically.
Like a checklist.
Exactly, like a pilot's checklist. This means making investment decisions based on these predefined rules, rather than trading on impulse, raw emotion, or some perceived informational advantage that, frankly, you likely don't possess compared to the millions of other participants in the market.
Can you give an example of a rule?
Sure. Simple rules like, I will only invest in companies whose business models I deeply understand, or I will only invest money I don't need for at least 5 years, or I will rebalance my portfolio back to my target allocation only once a year on my birthday, regardless of market movements. These rules become your guardrails against your own potentially biased impulses.
Got it. Rules beat impulses. What else?
Secondly, and this cannot be overstated, diversify, diversify, diversify. This is absolutely crucial, not just for reducing financial risk in the traditional sense, but also for inhibiting some of these behavioral biases.
How does diversification fight bias?
Well, for instance, it directly combats the familiarity bias, which naturally pushes us towards concentrated, undiversified portfolios of assets we simply know or feel comfortable with. Diversification forces you to own things outside your comfort zone. So don't put all your eggs in one basket, not one stock, not one sector, not even one country. And please, especially don't put too much in your employer's stock, as many mistakenly do, effectively doubling their risk if the company struggles. Think globally. Think across different asset classes like stocks, bonds, maybe real estate.
Okay, diversify broadly. Now, for those who are just starting out, maybe feeling intimidated by the sheer volume of investment options out there, and perhaps tempted by that desire to beat the market like we discussed, what's a realistic and effective approach that simplifies things and aligns with these psychological insights?
That's a key question for beginners. For many, and especially for young investors with a long time horizon, the most powerful and often most effective goal should simply be to strive for market returns. Forget trying to be the next stock-picking genius.
Just aim for average. That sounds unambitious.
It might sound unambitious, but it's incredibly powerful. Most active trading, which is often motivated by that very desire to beat the market, actually fosters the psychological biases we talked about: overconfidence, excessive trading, chasing winners, and, ironically, contributes to lower overall net returns for the vast majority of individual investors.
Right.
The strategies for achieving market returns, such as building a globally diversified portfolio using low-cost index funds or exchange-traded funds, ETFs, that simply track broad market indices. These strategies are successful precisely because they inhibit your biases. They remove the emotional decision-making. There's no stock picking based on gut feelings. There's no overconfidence needed. There's no chasing of recent winners. You're essentially buying the whole haystack instead of looking for the needle. It's a passive but profoundly powerful strategy that allows you to capture the long-term growth of the entire economy or specific segments of it without trying to outsmart it, which is incredibly difficult to do consistently.
Okay, that makes a lot of sense. Aim for market returns, let diversification and low costs do the heavy lifting. Now let's talk about practical habits. What tangible tools or daily strategies can young investors use to implement these principles of frugality and planning that the millionaire next door types use?
Right, the habits. Embrace frugality and planning must become core habits, not just, occasional good intentions.
Yeah.
This means actively managing your money, not just letting it manage you.
How to start?
Keeping accurate records of every expenditure is an excellent starting point. You simply can't control what you don't track or measure. you need to know where your money is actually going.
So track everything.
At least initially, yes. Tools like budgeting apps. There are tons of them now, like Mint, YNAB, Copilot, whatever works for you can be incredibly helpful here. They allow you to easily categorize spending, visualize where your money goes each month, and create a clear system or budget.
Okay. And the pay yourself first idea.
Yes, that's the fundamental strategy. Make it a rule. Pay yourself first. This means deciding on a percentage, ideally aiming for that minimum of 15% of your pre-tax income or more if you can, and investing it before you spend money on anything else beyond essential bills.
Make saving the first bill you pay.
Exactly. And automating this process is an absolute game changer. Set up automatic transfers from your checking account to your brokerage or retirement accounts on payday. That way, you never even see that money hit your main account, you don't have to actively decide to save it each time, and the temptation to spend it is drastically reduced. Out of sight, out of mind, into your future.
Automation is key. Now, what about those default options we often encounter in employer-sponsored retirement plans like 401k or similar plans elsewhere? They seem designed to make saving easy, which is good, but are they always optimal?
That's a really important point. While automatic enrollment policies have significantly increased participation rates in retirement plans, which is generally a very good thing, getting more people saving.
Right, it gets people started.
It does. But the downside is the status quo bias. This powerful bias means many employees passively stick to whatever the default contribution level is and whatever the default investment allocation is, even if those defaults are far from optimal for their individual circumstances, age, or risk tolerance.
What's an example of a bad default?
Well, sometimes the default investment is a very conservative money market fund or stable value fund, which might be okay if you're near retirement, but if you're a young investor with decades ahead of you, being stuck in cash essentially means you could be missing out on years, maybe decades, of potential compounding growth from equities. Or the default contribution rate might be very low, like 3%, which is unlikely to be enough for a comfortable retirement.
So don't just accept the default.
Please don't. Be proactive. Take the time, it doesn't take long to review your options, understand the different investment choices available, maybe use the plan's online tools or talk to HR. Don't just accept the default because it's the path of least resistance. Make an informed decision that aligns with your long-term goals and your personal capacity for risk.
Okay, be proactive with defaults. Finally then, how do we reshape our entire perspective on what it actually means to be successful financially and otherwise, and how we view risk? Beyond just the numbers on a spreadsheet or the technical definitions.
This is maybe the deepest level. It's about fundamentally redefining success and risk. We need to consciously shift our focus away from the external, visible displays of wealth, what we've called hyperconsumption, the big house, the fancy car, towards internal goals.
Internal goals, like what?
Like achieving genuine control over your time. Like having financial independence that allows you to make choices based on your values, not just financial necessity. Like living a life on your own terms. The advice from people who reflect deeply on their lives, maybe towards the end, is incredibly consistent on this.
What do they think?
They almost universally say that quality friendships, strong family bonds, contributing to something larger than yourself, and being respected by others for who you are, not what you own, these games bring far more lasting happiness and fulfillment than accumulating material possessions ever will. Humility, kindness, empathy, integrity, these qualities will bring you more genuine respect and connection than any fancy car or expensive watch ever could. Your true wealth, in many ways, is often intangible.
That's a powerful reframing. And how does this deeper understanding change our approach to risk in our financial lives? It sounds like it helps us manage that price of returns we discussed earlier, the fear and doubt.
Exactly. It helps put risk in perspective. Rather than chasing mathematically optimal strategies that might look perfect on paper but could lead to psychological ruin or actual financial ruin if they're even slightly off or if you can't stick with them, aim instead to be reasonable. Not rationally optimal.
Reasonable, not rational.
Yes. Choose investment strategies that maximize how well you sleep at night, even if they aren't theoretically the absolute highest possible return. Choose strategies you understand and can stick with through thick and thin. Understand that market returns are never free. They always demand that price in the form of volatility, fear, and uncertainty. But learn to recognize this not as a fine you pay for doing something wrong, but as the necessary cost of admission for the potential of higher long-term returns. Embrace it, or at least accept it, as part of the journey.
View volatility as the fee, not a punishment.
Precisely. And finally, and this is a critical buffer against life's inherent unpredictability, save for the unknown. While it's tempting, and sometimes necessary, to save for specific tangible goals like a house down payment or a new car, don't underestimate the power of building a general rainy day fund or just a buffer against life's inevitable curveballs.
Just general saving.
Just general savings, a cushion. Having that provides immense freedom and crucial psychological peace of mind. It prevents you from being forced to sell your long-term investments at the worst possible time during a market downturn or after losing a job simply because you need cash unexpectedly. That allows your core wealth to continue compounding undisturbed. As the great investor Charlie Munger famously said, something like, "The first rule of compounding is to never interrupt it unnecessarily." Having that buffer helps you avoid unnecessary interruptions.
Wow. Okay. What an incredible deep dive into the psychology of reaching that first $100,000. It's so clear listening to all this. It's not just about the numbers or market timing or finding the next hot stock. It's fundamentally about winning the mental game and really understanding ourselves better.
Indeed. We've really seen, I think, that the path involves a profound journey of self-discovery, recognizing and actively mitigating our inherent psychological biases, everything from overconfidence and the disposition effect to the powerful sway of social influence and herd behavior is absolutely paramount. But maybe even more importantly, it's about embracing those timeless, often simple principles, consistently living below your means, engaging in diligent planning and budgeting, truly understanding and respecting the incredible nonlinear power of long-term compounding, and consciously fostering true earned financial independence separate from external validation or support.
So what does this all mean for you, our listener, as you embark on or maybe continue your own financial journey towards that first $100 K or beyond?
It means that the journey to wealth, especially that first crucial stage, is a profound one of self-discovery and discipline. It's really about finding satisfaction, not just in reaching the destination, that $100 K number, but in the process itself and the constant setting and achieving of smaller economic goals along the way.
The journey, not just the destination.
Exactly. That joy and pride derived from building one's own fortune, from understanding the process, from gaining control over your time and your choices. That is, for many, far more satisfying and enduring than simply arriving at a particular numerical figure on a statement. The true reward, arguably, is the person you become in the process, the disciplined, the self-aware, the resilient, and the truly independent individual.
A truly provocative thought, perhaps, to leave you with today. In your own financial journey right now, are you focusing more on looking wealthy or on being financially independent and truly in control of your time and your choices? The happiness, the freedom, and the genuine lasting wealth might just be found overwhelmingly in the latter. What's one small step you could take today, right now, to align your actions just a little bit more with your deepest financial values and goals? Think about it.